The July numbers are in, really interesting data coming out of the market, and I'm going to interpret it all for you. I'm Dan Beer, Beer Home Team here at eXp Realty. Let's dive in. First off, what new listings. So in other words, homes coming to market or opportunities for people to purchase homes, 20.8% less new listings in July versus a year ago. So what really, to make sense of that, what's really happening in the marketplace is when you look at pending sales and closed sales relative to new listings. New listings down 20.8%, but pending homes down 34.7%, and closings down 43.3%. Now, of course, closings are homes that went pending 30 to 45, 60 days prior to that, so it's a very much a lagging measure. But it does confirm what we've seen. There's just less transactions, less activity, less liquidity in the marketplace. And the absorption rate is not as strong as it was a year ago because you only have 20% less opportunities, but 43% less closings. So we're going to continue to monitor that. Now, from the trenches and being in the business on a day-to-day basis and serving more people and more families than anybody in San Diego County, we can tell you that we've had the most active 10-day stretch at the beginning here of August than we've seen in all of July, easy. So we definitely see more improvement, and what that is that it's alignment in seller and buyer expectations coming together so that transactions can happen. So that's good news. Now coming back here, median and average sales price are both up 10% from a year ago. So there's this interesting environment where yes, there's less absorption and there's market changes, and sure, we might be entering a new phase in the market cycle. But for sellers that still want a great price, maybe not the peak price, but a great price, that's there. And then actually what we've seen is interest rates have come off of their highs. So there's opportunity for you to capture a lot of equity, lock in rates that are significantly better than they were a couple weeks ago. And if you need a connection to a great lender or a mortgage officer, happy to make that intro for you. Let's jump back into the data. Days on market up. Okay, so up 22% from 18 to 22 days on market. Now, if we go back a couple months, it went from 16 to 17, and went then from 17 to 18, and this past month, 18 to 22. So that rate of market time is accelerating, something to watch. It's still low relative to where we would ever be in a tough market. You go back to the 08, 09 Great Recession market, it was so much higher. But still, it's worth watching that market time is expanding. Affordability index down another 26%. There's been huge drops in affordability now for several months running, and that's because, again, we're just still in this zone of pricing being higher than it was, mortgage rates higher than they were, so that's really affecting affordability. Good news again, though, is that number is a slower rate of growth, or of decrease, I should say, in affordability than what we had in the previous 2 months. So that is a good signal. Also, literally just the Fed or the government just announced the CPI numbers came out, the consumer price index, and inflation down from what they had predicted. So not as bad as what they thought it would be. There's still much more inflation than we want or than the Federal Reserve wants to see, but it is improving. So the stock market responded really well, something to keep an eye out for. And where right now, as of this morning, the market was pricing in a 3/4 point rate hike when the Fed meets next month, we believe that we're going to see that possibly come down to a 1/2 point, and we'll keep you updated. Again, that's the Fed funds rate, not mortgage rates. And I know this can get confusing. That's why if you just need anything, reach out. We will go in and clarify, make sure you understand everything about it. Finally, month supply. We are up 50% in terms of inventory, okay? Month supply up 50% from a year ago. Now that's the news headline you'll see, because yeah, that is true. But the facts behind it is we've gone from 1.2 months to 1.8 months. And so this is just a really good place for me to remind you that careful with the headlines, because if you see a headline that says 50% up, inventory is skyrocketing, up 50%, well, yeah, but we've gone from 1.2 months to 1.8. So worth noting, but still at a tremendously high, low level, historically low levels of inventory. I mean, under 2 months, even if we were under 4 months, it would still be just a really good market. And For context, if you go back to the Great Recession, we got to where we had over 12 to 15 months of inventory, depending on the neighborhood here in San Diego County. So we're at 1.8 months. Still very little on the market, very little coming to market, and we will continue to track the numbers, interpret them more importantly, because anyone could see the numbers, but what do they mean? How do we make sense of them? How do we not let the headlines scare us and spook us? But also, how do we not put our head in the sand and face up to what's really going on so you can make the right and smart decisions? It's all about getting the intelligence, getting the information. We've been saying, we have this belief that that the market didn't hurt anyone in the Great Recession or in any recession, but what does hurt people is not having the right information, not having it interpreted correctly, having accurate data, and not having agenda-driven salespeople, but rather just people that'll bring you straight facts so you can make sense of them, do what's best for you and your family, and then someone you could ask questions of, regardless of if you're never buying a house, never selling a house, or if you're doing something in 10 years, or if you need it done today. What we need to do is just provide value, and the rest will come. That's what we're here for. I'm Dean Beer with the Beer Home Team here at eXp Realty, proud to serve.